Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back to the video trading recap for the trades that we made. This video is going to be a little bit different. It's going to be a little bit longer, and that's because Thinkorswim is going through some wonderful growing pains with their new platform. And by growing pains, I mean that it's not even working. So it didn't work all weekend, so I wasn't able to do the weekend video tutorial for expiration on Friday, 1/17. And then it really hasn't even worked at all this week. I'm still having trouble getting in, as I know many of you are. So because of that, I'm trying to use some other charts and to go back over some of the trades that we made on 1/17 and then also today, 1/22 January, Wednesday. So again, it's going to be a little bit longer, but stick with me. We're going to be using some different charts here today, so should be really helpful for you guys moving forward. So the first trade we're going to go over is actually a closing trade on DIS, which is Disney. Now we had sold this vertical call spread about a couple weeks ago, and so now it actually came in pretty nicely. We bought back the vertical call spread for February, the 77.5 80 call spread. We bought it back for a 44-cent debit, and we made a nice little profit of $46 per spread. So you can see just by the numbers, the $44 debit we paid and then the $46 profit that we made, we actually made just about half of the max potential profit on this call spread. So we're doing exactly what we preach in all of the video tutorials and all the courses that we have for free on OptionAlpha.com, is that with all of these call spreads, you want to close them out anywhere between 50 and 75% of max profit. You don't want to hold this thing all the way to expiration, because if the market gives you a good move, you want to take that move and run with it. So what does this mean when it translates into the actual chart? Well, here's a chart of Disney, and again, today Disney was up, so it was a good idea that we actually close out this trade. But you can see that since we entered the trade a couple weeks ago, Disney's moved almost straight down. So it did exactly what we wanted it to do. And although we didn't make our max profit, quote unquote, we took the trade off because we had made money on the trade. We made about 50% of what we could make. So to me, that's a really good trade. We'll just move on to the next trade and keep going forward. All right, so let's move on to the Iron Condor. We had an Iron Condor on Verizon, the 49.50 calls, and then the 46.45 puts. This expired completely at a profit, $43 per Iron Condor. So this was just a really good trade as far as timing. Usually we don't get Iron Condors that we don't have to adjust. It seems to be always some sort of little adjustment we make along the way. But with Verizon, the 49.50 calls and the 46.45 puts, we'll go to that chart and take a look at that as well. It just basically was a good trade. Implied volatility when we entered the trade was really high, and you can see that Verizon stayed right inside that range all the way through expiration. So we had ourselves a nice tight window basically from December on, and Verizon stayed right inside that range. Kind of tested our boundaries here up on 49, but that's again why we let these things go all the way to profit if need, or expiration if need be, because that allows us an opportunity for the market to play out its cyclicality. And you can see that it did that. It rallied up, tested our position, then came back down and kind of closed somewhere in between. So again, really good trade. Don't do a lot of Iron Condors because they're hard to put on, and especially I know that people have trouble getting filled with a lot of contracts. But you can see this was a pretty clean Iron Condor, just 2 of them, so it was very easy to get in and out of. All right, the next trade that we closed out, or that expired, was the vertical calls put spread on JNPR. This closed out at a $50 loss. Basically, there was nothing to say about this one other than it was just way out of the money by the time that we had actually looked at closing out the trade near expiration, and there's no point in rolling it. So we've gone over rolling before, and right now our position was at 22.21 on the put side, and when we actually go to JNPR, you'll take a look at it and you'll see that's all the way up around 26. So they had really good earnings and popped up, and that's really, again, this is why you trade small, because you get these dumb luck trades like this, or not dumb luck, but dumb bad luck, I guess, that you have a nice pop-up in the stock after earnings. So there's really nothing you can do about that. We made a 50-50 directional bet, but we kept our position size small, so it's not going to hurt us overall. All right, so heading back to the actual tab here for members, we take a look at the trade we made in EWZ. This one, again, expired completely profitable. It was the 46.47 call spread in EWZ, and this one basically remained profitable for most of the month. We actually, again, go back to the chart and take a look at EWZ. You'll notice that it continued to move downward pretty much all through January expiration. So it continued to move down, and we had sold the 46.47 call spread. So again, it just moved right away from our position. We could have closed it out earlier. In fact, we tried to close it out, but really by the time we got near expiration, there was no ideal opportunity to close it out at a 2-cent penny or debit or anything like that, because it was just so close to max profit and expiring worthless that we just let it go all the way to expiration. All right, so the trade that we made, that we closed out today, so jumping back, still staying on the closing side of the tab, but going to the trade that we closed out today, this was the vertical put spread that we had in UNG. So we actually closed this one out a little bit early. It was only a couple days that we had this trade on. We had it on since Thursday of last week, so it's only been on a full 3 working days. We made a nice little $8 profit on it. It wasn't a lot, but the reason that we close out this trade with UNG is because implied volatility is really, really high in UNG right now. And although we had a nice directional movement away from our strikes, implied volatility is still, excuse me, at about the 100th percentile. So what we want to do here is kind of reset our position. And we had a working order in today, but didn't fill. But we want to reset our position with maybe a nice butterfly or an iron condor. So that's the reason that we close this one out. Right now, with 100% implied volatility, we could have held this position on, but we want to kind of reset our strikes. So we took a nice little profit on the put side of the trade, and we're going to try to bracket the market and either do some sort of strangle straddle or iron condor and butterfly. So again, those trading alerts will be coming out to members who are subscribed. All right, so let's go over the opening trades that we had today. So again, as a reminder, this video is getting a little bit longer than I like it to be, but just stick with me. A lot of the same mentality goes into some of the trades, so I'll kind of section off what trades we made on Friday last week. We sold a nice vertical put spread in Starbucks. Starbucks implied volatility very, very high right now. So we sold the 72.5 70 put spread for 65 cents. Again, not that we think Starbucks will continue to go higher, but it's definitely looking like it could continue to move higher. At least that's our assumption. And so with implied volatility as high as it is now, we have an opportunity to sell a put spread and take in some premium. The vertical that we bought on BBY is purely a directional play. So we bought the 24-26 call spread for 95 cents. Now, if you follow us long enough, you'll know that all the directional vertical spreads that we buy, these debit spreads, we like to buy them at a price about half the width of the strikes. So in this case, the width of the strikes, the 24-26, is $2. So we like to pay about $1, and in this case, we got a little bit of a discount. So I will go to the chart of BBY just to show you why we made that directional assumption. Again, BBY does not have high implied volatility right now, but after the huge move down that it had, kind of this gap move down that it had just the other day, we do think that there's a good opportunity that it could rally and kind of fill this gap. So that's the reason why we made the call side direction of the trade as opposed to the put side. It's just a pure directional trade. Usually what we see with these gaps is that the stock fills the gap. Even as big of a gap as it made right here is about a $10 gap in Best Buy. Moving on to Dow. Dow is another one that has really high implied volatility. This one's a little bit different. So we actually bought a butterfly in Dow. So we're starting to trade some of these different advanced strategies than what we usually do because implied volatility is very high. We made a lot of money with Dow this year, and so we're going to go back to it again. And this time we traded the 42-44-46 call butterfly, and we paid a debit of 44 cents. Now I wish I could show you the profit loss diagram on my Thinkorswim platform, but again, that platform's not working. So we just have to look at the chart and kind of show you where this is positioned as far as where the sweet spot is. So remember that with all butterflies, and this is an even butterfly, it's not an unbalanced or broken wing butterfly, all of the strikes here are evenly spaced. So $2 apart, the 42 calls, the 44 calls, and the 46 calls. This means that our strategy is centered right around 44 as a price for Dow. So ideally, we'd want Dow implied volatility to drop, but we'd also want Dow to possibly rally up a little bit higher to around 44. So we positioned our call butterfly in that way so that we actually give ourselves a little bit of upside room. We didn't actually, when we made the trade, didn't position it right at the strikes that it was currently trading at. So let's go and take a look at Dow, and you'll see exactly what we're talking about with how we positioned our trade for a little bit of call side movement. Okay, so you can see that when we actually made the trade here, just on Friday, that we actually had the trade when it was down here at 42. And so right now we positioned ourselves right around 44 as an even mid price. And so you can see that Dow jumped up in its price. Implied volatility had a little bit of a drop here as it jumped up, but now it's trading up around 46. This is still within our window to make money. So remember, we traded the 46, 44, and the 42 calls. So really, we make the most amount of money at 44. It starts to taper off as we get to 46. So I actually feel pretty good about this position going forward. Again, right now that it's gapped up, we have a tendency to see gaps continue to fill that gap. So if Dow does fill the gap that it just made, that would put it right around our mid price of 44 on the strike. So that trade's looking good. We're still going to continue to hold that trade for as long as we need to. All right, moving on to HPQ. HPQ, another one of these directional trades, not going to go to the chart on this one. We bought 5 verticals in HPQ. We moved out to March, give ourselves a little bit more time. But again, it was a $2 wide put spread, the 31.29 put spread. We bought it for a mid price of around 105, so we paid a little bit over mid price for this one that we usually like to pay. We usually like to pay about $1 for these strikes, but really just a directional trade on HPQ and also adding some negative delta to our portfolio. All right, so excuse me. So getting to the trades that we made here today, made a couple of nice credit spread trades. I'll go over those first. The first one was in Baidu. We sold the March 155, 150 put spreads for 111. Again, only because Baidu implied volatility is much higher than it typically is. I know we have earnings coming up for Baidu, so I wanted to trade the put side of the market, leave room for the call side in case it does gap up with its earnings. That was just purely a directional trade and decision. You could have traded the call spread. It doesn't really matter which side of the market you trade. On Priceline, we also traded a vertical put spread, the 1145, 1140 put spread. You can see we trade that for about the same price and credit as the Baidu put spread, about 115. Again, selling this below the market, leaving room for the market to come back up as it gets closer to the end of the month here in January and then into February. And then finally, it made a directional trade on X, which is US Steel. I do want to go over the chart of this one just to show you, again, one of these directional trades with low implied volatility. So X, which is US Steel, has very low implied volatility right now. So we actually bought the 28.25 put spread for 156. Again, you'll notice the width of the strikes here is about $3. And so we like to pay about half of that, half of the width of the strikes. That put us at about a $1.50 target. Paid a little bit over that, but that's okay. Got into the trade. And again, you'll see here on the chart that X continues to move higher, or lower, so we actually wanted to trade the call spread in the market here. So, we actually traded the put spread side of the market, hoping that X will continue to move down. So it's actually had a rough month here, trade the put side of the market, hoping that it continues to move down. Again, 50-50 bet on this. We paid about half the mid price, so all we're looking for here is X or US Steel to trade anywhere below where it's trading right now between now and February expiration. So that's the ideal trade here for X. So again, hopefully you guys enjoy these videos. I know this was a little bit longer. My voice, as you can hear, is a little bit hoarse as I'm starting to pick up a cold here, dealing with all these Thinkorswim people and using tech support and all that stuff that's really not working for them. So hopefully they get it figured out. We'll go back to the regular charts and looking at trade tabs. But this definitely gives you a summary of what we've done since expiration on Friday. And again, we'll use the same charts tomorrow night if need be, but hopefully their platform will be back up and running. So as always, please ask any question you want below, and happy trading.